One of the things I see with people who are newly retired is that they're not taking full advantage of their standard deduction. So in July of 2025, the Big Beautiful Bill Act was passed. And so for those tax filers over the age of 65, especially married filing jointly, they each have the opportunity for an additional deduction of $6,000, which is $12,000 for the couple. So in 2026, their total deduction is about $47,500. And what I tend to find is people are not necessarily utilizing all of that. And if you don't use it, you lose it. So in this video, I'm going to go over a couple of different scenarios as to how this couple could utilize their standard deduction, including their enhanced senior deduction, to do some planning techniques to save them taxes longer term. So let's get started. So this couple, John and Sally Smith, they're both aged 65 and both newly retired. So what we're going to look at here is they're going to retire at the start of 2026. So we'll go from left to right to take a look at this base case. But in 2026, they expect, given the fact that their savings is a combination of retirement accounts, brokerage accounts, and bank accounts, they expect their taxable interest to be about $12,000, their qualified dividends in their brokerage account to be about the same, and there's some non-qualified dividends in there as well. So their overall income for the year, along with some of the capital gains, they're expecting total income to be about $33,000. So in this case, they have a standard deduction of $35,500, and because their income is lower than $150,000, they get the full advantage of the senior enhanced deduction, and that deduction lasts from 2025 to 2028. So it's temporary, but for 26, certainly a benefit. Now, when you take that all into consideration, well, there's no tax due because their deduction exceeds that of their overall income. So they have a $47,500 deduction, but only $33,000 in income. So they're missing an opportunity to be able to at least match that standard deduction. And what we'll look at next is one of the questions that John and Sally may have is, well, should I start claiming Social Security? Well, if they did that in 2026, their Social Security, the expected Social Security, would be on top of the other sources of income. So they would expect about $50,000 between the two of them. Social Security is only taxed up to a maximum of 85%. So only a portion of that would be taxable. However, that would be part of their ordinary income, which would be utilized or applied toward their standard deduction. So all else being equal, if they claimed Social Security, they would find themselves in a situation whereby they would be in a very low income scenario, and again, not owe any overall income taxes. So that's a choice that they may want to consider as claiming their Social Security. Another choice they may have, especially now, because in their circumstances, they have most of their retirement wealth in retirement accounts, which means it's tax deferred. And at some point, they're going to have to start taking withdrawals, even mandatory distributions later on in life. So John and Sally have the vast majority of their retirement portfolio in tax deferred accounts, like most people do. And in tax deferred accounts, every dollar that comes out is going to be taxable income. And that could cause some issues later on in life when especially their mandatory distributions come into play, and they may find themselves in a higher tax bracket potentially later in life due to those mandatory distributions. One of the ways to be able to mitigate that to a certain degree is to use periods of time like what John and Sally have in front of them right now, where they have very low taxable years, to make Roth conversions and take some of that money from the larger tax-deferred retirement accounts they have, convert it to the Roth, pay the taxes on the difference. And in this case, we'll take a look at a scenario whereby they're going to utilize their standard deduction to effectively do a tax-free Roth conversion, since they're using to its fullest their standard deduction, which really should be done in any case because you don't want to leave money on the table with respect to your standard deduction. So in this case, we'll take a look at the Roth conversion case. Same inputs, same income. So we're looking at an opportunity whereby they could Roth convert $33,500 and find themselves still in a scenario where they're going to not have to owe income taxes, at least federal income taxes. So that is an opportunity for them to get $33,500 into a Roth IRA. Between the two of them, it could be any derivation as far as who wants to do what. But from that perspective, collectively, they have an opportunity to move a decent chunk into a Roth IRA and not increase their tax picture. Now, I've made the assumption that they are both New York State residence. And so New York State taxes would be due. So in either case, in their base case, if they just had the income with no Roth conversions and didn't claim Social Security, their dividend and interest income would result in a certain amount of state tax liability. In the Roth conversion, that although it wouldn't trigger any federal income taxes, there would be an amount for state of New York taxes. Now, let's see if we can put them all together. So let's say they do a Roth conversion and claim their Social Security. And in that case, if they wanted to stay at 0 federal income taxes paid, again, utilizing to its fullest their standard deduction, instead of $33,500, they could do $8,000 to the Roth and still be in a 0 tax environment for the federal government. So all else being equal, they get to use to its entirety the standard deduction, and they're not leaving anything left on the table. Again, if you don't use your standard deduction, you cannot carry it forward. So every year you want to make sure that you are utilizing your standard deduction to its fullest. So in the case, again, there would be some New York State taxes due with respect to that type of scenario. But in this case, I wanted to just highlight some of the things I, as a practitioner, run into fairly frequently with people who are heading into retirement because their income goes from typically the peak years of their earnings, where they're paying a high level of taxes, to literally 0 taxes. And I tend to find a lot of people like that scenario because they're just happy that they're not paying any taxes. But you just want to be able to look under the hood a little bit to understand how it is that you can utilize this low tax scenario to be able to maximize your longer term planning needs and lower your overall tax bill over the course of your life as well. Another item that we could take a look at here is filling up tax brackets. So in John and Sally's case, if they said, well, I'm okay with paying some taxes, but what if we just filled up, let's say, the 10% tax bracket? So in the next scenario, we can explore filling up the 10%. So the lowest tax bracket, the lowest federal tax bracket. Say, if we step into this, how much more could we convert? So the assumption that I'm using here is that they're not going to claim Social Security so as to give themselves more room for a Roth conversion. And in that case, they would be able to Roth convert $57,500 to fill up that 10% tax bracket. Now, the key thing to take a look at here is that there will be a certain cost to be able to do that, but the effective rate is a little over 4%, which for most taxpayers, that effective rate is going to be one of the lowest effective rates you're ever going to see. Certainly lower than what their future anticipated effective tax rate is going to be when they take mandatory distributions. So the overall cost to do this, which is $2,400, is relatively low compared to what they anticipate paying in the way of taking distributions later on in life. So in that perspective, this is a way to say, all right, how is it that they can pay taxes strategically and take advantage of an opportunity to move a fairly decent amount of money out of their regular traditional tax-deferred retirement accounts into a Roth IRA. So when it comes to this, looking at a year-by-year basis, if you take a look at stringing these all together, this could have a fairly significant tax impact later on in life. So we're looking at it on a year-by-year basis. Additional planning could take a look at a strategy that covers multiple years, especially if John and Sally anticipate themselves to be in relatively low tax brackets up until either they claim Social Security or when their mandatory distributions end up taking place, which for them, since they're age 65, is another 10 years, which offers them a 10-year strategic window to be able to look at Roth conversions in a way that can help them offset future taxes. So the bottom line here is making sure that you utilize your standard deduction to its fullest. And the Big Beautiful Bill Act offered those over the age of 65 with relatively low incomes an opportunity to do some enhanced planning and stuff a little bit more into Roth IRAs or choose to claim Social Security. So the passage of the Big Beautiful Bill Act offered those over 65 with incomes lower than $150,000 a little bit more room to either offset some of the taxes with respect to what they would pay on Social Security. I think that was the intention of this. One of the items in the bill that was debated was eliminating taxes on Social Security. So the Big Beautiful Bill Act did not do that. What it did do is offer this limited enhanced senior deduction, which for those in this case that choose to claim Social Security or have already been on Social Security, it does help reduce some of the tax impact with respect to that income. So in this case, make sure that you're always utilizing your standard deduction. And from the purposes of this video, make sure you're always consulting with your tax legal, and financial professionals. This is for educational purposes only. So from that standpoint, every circumstance is different. Make sure that you are interacting with your professionals to understand what course and strategy is best for you.